Although a final agreement was not reached last week, the relatively restrained posture of both parties has led the market to lean toward a medium to long-term outlook of relative peace. This shift exerted downward pressure on oil prices and the US dollar, while risk assets saw varying degrees of rebounding. This topic will remain in focus this week, but tangible results will be required to drive meaningful market movement. Simultaneously, Federal Reserve Chair Jerome Powell's term concludes this week. The policy direction set by his successor, Kevin Warsh, will be a key long-term focal point for the markets. The U.S.-Iran situation presents a complex fight while talk, sanction while engaged dynamic. According to CCTV News, sources in Pakistan indicate that both sides are nearing a memorandum of understanding for a ceasefire. Donald Trump has further noted that a deal could potentially be reached next week. On the other hand, direct skirmishes have broken out between U.S. and Iranian forces near the strait, maintaining a high-risk profile for a Strait of Hormuz crisis. Jerome Powell's term as chair of the Federal Reserve is set to conclude on May 15, with Kevin Warsh expected to succeed him. Powell has stated that following the end of his chairmanship, he will remain on the Federal Reserve Board of Governors, as his term as a governor has 2 years remaining. WTI crude oil continues its pattern of dramatic swings seen over a considerable period. Following a week of volatility, it closed below the $100 mark, with bears gaining a slight advantage. However, the nearly equal length of the upper and lower shadows suggests a state of directional neutrality. From a fundamental perspective, the risk of a new round of hostilities is low, suggesting a higher probability of a downward tilting consolidation. Technically, the persistent failure to register new highs indicates an eventual slide toward the $80 lower bound. This broad-range oscillation is expected to persist for the next 1 to 2 quarters. Only an unexpected breakout above $120 would pave the way toward $150, while a drop below $70 would be a surprise outcome, signaling the definitive conclusion of the Middle East narrative. In the long run, the U.S. midterm elections in the fourth quarter are expected to provide fresh momentum for a decisive directional choice. Gold staged a bottom and rebound performance last week. After unsuccessfully testing the 4,500 level for 2 consecutive weeks, the bulls launched a counterattack, resulting in a bullish engulfing pattern on the weekly chart. Nevertheless, the upward momentum does not appear strong enough to reignite a full-scale bull market, with the prevailing bias leading toward a rally and retrace scenario. The 4,800 mark will be the primary focal point and resistance for the week. A successful breach could pave the way to fill the price gap above 5,000, though further upside potential remains constrained. On the downside, a break below 4,500 would likely lead to a test of the 4,400 level. The risk of plunging below 4,100 in the near term remains limited, and the overall rhythmic oscillation is expected to persist. The US dollar failed its rebound attempt once again last week and drifted lower, closing below the 98 level while barely managing to hold near or above the critical long-term trendline. Driven by correlation logic, as the upward momentum of oil prices wanes, the dollar's position has also begun to look increasingly fragile. The theoretical target for the small double-top pattern on the daily chart sits near 97.5. This level has been tested multiple times, and a decisive breach would signal an acceleration of the downtrend, potentially leading to new lows. For resistance, on any rebound, watch the struggle around 99. A move above this would suggest a return to equilibrium between bulls and bears. Under current fundamental conditions, the risk of the dollar remaining under pressure and entering a slow bleed phase is rising significantly. USD/JPY closed with a doji last week, as technical buying from bulls and intervention-driven selling from the central bank remained in relative equilibrium. A long-term trendline provided support right around last week's lows. A breach of the 155 level would suggest a further decline toward the 150-151 area. Meanwhile, significant intervention risks persist near 159-160, limiting short-term upside momentum and potential. Should the pair undergo a natural correction and slide below 152, long-term fundamental advantages would present an ideal buying opportunity. Conversely, if the pair fails to break lower, it may fall into a near-term stalemate. Bitcoin marched higher last week with a moderate bullish candle, continuing its trajectory toward relatively higher levels. With the 80,000 mark now appearing stable, the probability of a continued rebound in the short to medium term remains high. However, the 90,000–100,000 range presents formidable technical resistance, serving as a zone of significant historical high-volume turnover between bulls and bears. It is expected to thwart at least the initial attempt at a breakout. From a long-term perspective, a relatively cautious outlook persists, as a resumption of the downtrend is deemed likely once this corrective recovery concludes. Key weekly support sits at 78,000–76,000. A breach here would dampen the rebound momentum, though a definitive turn to weakness would require a close below 74,000.